Welcome, everybody, and thank you for joining us as the Economic Club of Las Vegas hosts John Silvia and Beth Ann Bovino to discuss the 2022 Global Economic Outlook. The Economic Club of Las Vegas is a nonprofit, nonpartisan forum for economic discussion. We bring experts on regional, national, and international issues to our Las Vegas audience, allowing us to hear from the experts and offer our own questions and ideas in return. The club was formed in 2013 and is also an affiliate chapter of the National Association for Business Economics. Before we begin, I'd like to recognize the hard work of our board and officers. Without their commitment to the club, these events would not be possible. I would also like to thank our sponsors for their generous support, both in terms of financial support and in helping spread the word about the club. Also like to note that the opinions expressed here may not be the opinions of the club, but we greatly appreciate them all. Without further ado, I would like to introduce both of our speakers. Beth Ann Bovino is the U.S. Chief Economist at S&P Global Rating Service based in New York. In this position, she develops S&P's U.S. economic forecasts and authors the quarterly U.S. economic forecast, the biweekly financial notes, and the business cycle barometer. Beth Ann has written timely research reports on long-term economic trends, has created industry drivers for analyst research. She's quoted regularly in the press and has appeared on many major television programs. Further, she has written many articles for popular professional publications. John Silvia is enjoying the process of launching his firm, John E. Silvia Dynamic Economic Strategy. John retired from his position as Managing Director and Chief Economist for Wells Fargo. John was formerly a director of NABE and was the former president of the Charlotte Economics Club. He also served on economic advisory committees to the Federal Reserve Bank of Cleveland, Federal Reserve Bank of Chicago, and the Public Securities Association. Without any further ado, I'm going to turn this over to Beth Ann.
Great, thank you, Jason, and it's great to be here again. This is, I guess, I think we have improved dramatically from last year's Zoom meeting when I think it took us about 15 minutes to get this set up. So looks like we're moving. Hopefully, we won't have to do this again, but it's good we're able to move in the right direction, at least that. What I was planning to talk about is North America economic outlook. I largely focus on the US, but we also look at Canada as well. And in both cases, we're looking at something that we would call as growing pains. The US economic and Canadian outlook still looks to be a pretty healthy reading. Perfect, thank you. Oh, and Jason, you'll be doing them. So anyway, growing pains. Since I think you're handling it, could you go to the next slide, please? And this is what I mean. This is the growth path that we see for both the U.S. and Canada. If you look at the right, at the left-hand side, the U.S. you're seeing a slowdown on supply constraints. If you're looking at what we're having here, our December forecast was the blue line, the light blue line, way down below. Now, keep in mind what happened before. Since then, we've had several fiscal stimulus package, which lifted the growth forecast pretty much dramatically. In addition, the U.S. has been able to basically adapt to the several hits of the virus and continue to move along. So you can see the growth levels that we're looking at here. Indeed, what we're expecting for the U.S. now, you see the slowdown since June. It's dropped, but it's still at pre-crisis level, pre-crisis trends. What slowed it, of course, is the supply chain disruptions. We're looking at growth now has been dropped down dramatically from where we expected it back in June, when we had expected a 6.7% growth for 2021 and a healthy growth of around 4% for 2022. Now what we're looking at, we have it 5.5%. That's shaving off about a significant amount from 2021, but it's still a healthy reading. Again, growing pains. We're looking at a 37-year high. For 2022, it slowed down. We also expect it to slow down, again, specifically tied to supply constraints, but we're looking at 3.9%. Yeah, it's a little lower than what we thought, but put it in perspective, that also is about twice what is potential growth for the United States. So it's a healthy read. On Canada, you can see also Canada slowing down as well. But one of the reasons why there is largely significantly tied to the three and then fourth waves of COVID-19, where Canada did go into more of a lockdown mode than the United States has, despite the virus in the US. And that did slow growth. But keep in mind, that's also a pretty good reading for what we expect for the year for Canada for this year and the next. In both cases, back when we look at what's happening with the US, we're seeing, as we will talk about a little bit further, we can see that the supply chains have also started to ease. I'll talk about that a little later, but it's also, as we all know, added a significant amount of price pressures for the Fed to deal with. What we're expecting now is the Fed to speed up tapering. I guess they're going to make the announcement tomorrow, where it will end, likely in our mind, reach zero by March of next year. That gives them a lot more room to be able to move in rate hikes. We still have a rate hike for 2020 and September 2022 with 5 more that follows, but it wouldn't surprise us if they move that forward as well. On Canada, Canada's moved a little faster already. They've already finished tapering. I think they finished in October of this year, and we think they'll also move a little faster on rate hikes as well. Go to the next chart. For the U.S., I mentioned why has the U.S. economy why are we looking at a 37-year high? Because the indicators are hot. Here you're looking at job postings. Now I should add, job postings are again at a record high for Indeed. I don't have it on this chart, but you can also see that initial jobless claims are, I believe, at a 52-year low. On the top right, you can see that people are still spending despite the sticker shock at the cashier. Indeed, that seems, and we expect that to continue through this year and even into the next, as households want to have, basically are allowing a little bit more forgiveness, at least for the time being, in order to have a wonderful holiday season. Bottom two, on the bottom left, you can see leisure activity has slowed, although it's still holding close to 2019 year levels. That explains a big factor is because of particularly the fear of the virus, which we also will talk about a little bit later. But that fear of the virus is also that fear of the virus is keeping households and from traveling a bit more than they had usually before, and also the sticker shock on the airline ticket is also maybe making them more reluctant. And indeed, business travel is slowed. Look at us. Now, I know that Ken wanted us to come out there, and that was a possibility, but there are restrictions on the business side, on business management. So one of the reasons why that's also slowed. On the right-hand side, you're looking at a breakdown of the components of fixed investment. Housing leads the way as that sharp V-shaped recovery. Manufacturing is also hot, or machinery is also hot. But where's the drag? Non-residential construction, which at least it's kind of flattened out. But the question of when we'll see that turnaround is still up in the air. Talking about supply constraints, a lot of people focus on goods supply constraints, and that certainly is there. But we wanted to point out the labor market mismatch that's at play here. On the left-hand side, now we looked at our reading that came out, I guess in November, where we had, I guess it was 210,000 job gains. Pretty weak and somewhat of a disappointment on the headline reading. However, there were upward revisions that brought that up to maybe an average of about 500,000 job gains for that month if you added them all in. And in that case, that's our baseline forecast. And if we kept to a monthly pace of about 500,000 job gains, when we would expect to see the U.S. get back to pre-pandemic full employment, not until fourth quarter 2023. Given a reason why the Fed is going still rather slow, given this hot economy. Now, if we stayed at about 200,000 going out on a monthly basis, we wouldn't get back to pre-crisis levels until 2025. Something to consider. Now, what are the reasons why? It's not about unemployment. On the right-hand side, we're looking at the so-called Beveridge curve. This is really giving a sense of what is the slackness in the jobs market. What you do is you compare job openings on the left-hand side relative to the unemployment rate. And it's called a Beveridge curve. That's the guy's name, but it's a curve because it makes sense. When job openings are high, unemployment rate is low. When job openings are low, unemployment rate is high because it's not a strong economy. What we've seen now, all those are different variations of different points in time for the United United States. And what you can see is that that top line is where we are now, and it's shifted out. And that just gives you a sense of the extreme mismatch that the U.S. economy is going through right now. The supreme jobs mismatch. Now, what are the reasons? We'd like to point out to a couple things, and what we would point out in particular, it's not about unemployment. The unemployment rate is at 4.2% at this point in time. And if we were looking about the jobs mismatch, it's really tied to people exiting the workforce. The unemployment, unemployed workers make up about 30% of the overall lost workers since the pandemic. 75% is tied to the labor, to those people who left the workforce. And in that sense, what we've seen there is, why did they leave the workforce? Well, a lot of it is fear of the pandemic, not just for themselves, but particularly for their family, either elderly family members that they watch over, or those children who are under the age of 5 and do not have the vaccine. So these are the factors that are at play. And we do see this as temporary, but again, the question is how temporary? How long will it be before they get the confidence to come back? Now, there is, in our sense, we did an analysis of this, which is we did a breakdown of the labor participation rate, which is at a 45-year low. We found out about 40% is tied to age-related retirements, largely, and of course that was probably sped up by the pandemic. But this close to 60% are those folks that left the workforce of prime age in particular. The question is, when will they come back? Could you go to the next slide? Now, the V-shaped recovery is one thing that I mentioned it earlier on, and this is something that we're keeping an eye on too. The V-shape, and I know this matters for the Las Vegas market. On the right-hand side, on the left-hand side, you're looking at, basically there's a V-shape in both cases, both in the US and in Canada. On the left-hand side, you're looking at housing starts. Now, it's moderated, as you can see in that blue line, somewhat, but that's extremely high levels. And why is that? Because of home prices, as you can see in the S&P Case-Shiller Index, which actually is I believe at another record. So that explains why you're seeing the weakness now, or softness. Now, the softness is still a question. The overall strength, which still holds up, is largely because, well, people left it. Low interest rates, high, strong stock market so that they could pay for that down payment. And of course, the fear of the virus let people leave the market, leave the crowded cities and either buy a first home, second home, or for many, or for some, even a third. On the right-hand side, the same held true for Canada. Housing starts in Canada have come down significantly, as you can see, from that record high that they had in March. As you can see at that pop, that was their record high in March for housing starts, but it's still incredibly robust. As they go through, as it slows down further. Go to the next slide. Now, since we were talking about high prices, and Canada also has high prices as well, that brings us to the big question of inflation. What's the real drivers for both Canada and for the U.S.? But let's talk about the U.S. first. I didn't mention this in my earlier comments, and I should bring it up right now. What are the downsides for the U.S. forecast? What we look at is we do a downside and an upside to our forecast. I mentioned that our baseline right now is about 5.5% for this year, and a little close, and about 3.9% in growth for next year. The downside is a tighter Fed, a disorderly reflation story, and of course, repricing risk. There's other factors that could be at play. New variants, we're already talking about the new one after Delta leaves the stage, and of course, risk of trade tensions with China. But I'd like to point out that our downside risk is not for a recession. It's actually for slower growth. Indeed, the recession risk we have at this point in time is just around 10 to 15%, which is, according to our estimates, about the lowest we've had in almost 7 years. Now, I mentioned inflation and a tighter Fed and a disorderly reflation. That's the big question that's at play. If you're looking at these charts right now, on the top, I guess you could say these are the quote unquote good news. Now, core consumer prices, it's not taking into account last week's reading, so that gives it another bump up, and I'd say it's probably even more challenged and maybe not so much good news. But I guess the point I wanted to make here was that the 3-month change, at least as of possibly before the most recent reading, was still below what the peak was in the second quarter of this year. Now let's see where that is right now, and it could actually rival that, but that was one point to get to know. The other thing I wanted to point out, and I mentioned this earlier, is that we have seen some signs of supply chains starting to show signs of easing. On that top right is looking at Taiwan's manufacturing backlog of orders. Now, Taiwan is the leading producer of semiconductors. The huge shortage of semiconductors, this explains why auto sales and auto prices have shot through the roof, as well as also in technology overall, where we're starting to see that come back to, I guess, get back to near normal, which suggests there might be some voting of possible easing later on. We don't think this year, but sometime in 2022 is a possibility. In other areas, on the bottom left, you're looking at lumber prices, well off reopening highs, probably because new homes have weakened in the United States because of basically too much money, or too high a price. On the bottom right, you're looking at the Baltic Exchange dry index. That's also coming down. Now, this is a much more volatile reading. It's not necessarily saying that prices have dropped. It could be that demand has slowed. But again, it's one thing that we look at to suggest that there are some signs of easings. Now, the point to make here is that we are seeing some signs of easing, but they are still well above pre-crisis levels. So it still has a way to go. Go to the next slide. I think might be my last slide, or the one after this. The last slide is this second to last slide is inflation. This is the bad news. Top left, hourly wages. This is looking at the Atlanta Fed. That is at a 14-year high. Not just the paid hourly workers tied to leisure and hospitality, but the overall weight is now at a 14-year high. I should go to the bottom left on that chart. Even though the inflation wages are so high and businesses certainly feel the sting, in real terms, real average hourly earnings are in negative territory on a year-over-year basis. So even those workers are still complaining. So that's still an issue. On the top right, I mentioned this briefly when I talked about that breakdown of what explains that labor force participation rate. That's that blue line, which is an actual number, a 47-year low. We did the adjustment, taking out the age-related factor. It only makes up about 1/3, or about 40% actually. The rest is tied to pandemic related factors. On the bottom right, now there is some signs of improvement here, but the overall issue and why we think the Fed blinked and needs to move, it plans to move much sooner than they had earlier indicated, is that forward inflation expectations are now at, I believe, a 10-year. If you read that, it's about a 10-year high. That means the worry of persistence in inflation is something that is a concern, and that's why we think the Fed blinked. Now, I see down here, I mentioned that we expect them to finish March tapering purchases by March. First rate in September 2022, and 5 more to follow. I think that I would not be surprised if they move that rate hike even sooner than that September rate hike, and possibly even 2 for the year would not surprise me in the least. The last chart I just wanted to point out on Canada real quick is that on Canada, actually overall you can see QE. I just wanted to show you the share of the U.S. and Canada relative to the rest of the world as a share of GDP. It's still rather small, and as I noted, Canada has already moved on tapering. They're down. They're back to 0 already. On the right-hand side, Canada is moving. We expect Canada to move even sooner than the U.S., but they're kind of in lockstep. Canada might move maybe a few months earlier, depending on what the Fed says today or tomorrow. But again, it seems like they're both on the move to raise rates as they move along. Let me stop there and pass it to John.
Great. Simple title slide. First, I want to thank, of course, Wells Fargo for continuing to be a sponsor of this Outlook session. Second, I know Jason was being humble, but these presentations obviously do not represent the club or particularly the official position of our institutions, but they should, because these presentations are in fact correct and they're giving you the right information. And for those of you that are interested, Ken knows that I update these graphs and these tables for him all the time. So if you're interested, I can update this sometime in the mid-year. But anyway, I certainly agree with what Beth Ann had to say. The economic cycles, the signals look very good. Jobless claims continue to decline. The ISM manufacturing numbers continue to show expansion. Factory orders are up and unfilled orders are up. And it's the unfilled orders that really give you a signal of what's going to happen 3 to 6 months from now, but it also tells you a little bit about the backlogs that are involved in the US economy. The building permits number that we follow, single family is up, multifamily is down a little bit. Actually, again, as Beth Ann pointed out, home prices up incredibly strong, 19.5% year over year. Again, there's housing affordability issues that I think are developing in the marketplace. And one thing that signals, I think, a slowdown that maybe Beth Ann was talking about is consumer confidence is down, both present and expectations. So there's a little bit of a hit here with respect to confidence. And I think Beth Ann had, again, interesting point that when you look at real incomes, the bottom half of the income distribution is seeing a pace of inflation that exceeds their wage gains. So the real wage gains are actually declining. So we're looking at the financial markets. And so many of you know the equity markets has been very strong. The dollar has been up recently, particularly against the euro. A lot of questions about the pace of growth in the euro community, as well as its economic prospects. Corporate profits continue to be solid. I do like that both the 10-year and 2-year rates are up. That's a good signal for the economy. As many of you know, and certainly Ken is aware, I think these interest rates are way too low for an open market economy. The Fed is engaged with all its QE in terms of interest rate suppression. And I think that's a problem longer term, trying to get the right price in the marketplace. It is good that both the AA and high yield spreads are up a little bit. Again, still pretty optimistic on credit risk, but it's good to see that there's some adjustment there on risk. So here, going through the household sector financials, I always look at the financial obligations ratio. Again, it's all public information, but when you look at the graph, it's pretty clear that the 2007-2009 housing crunch really represented a structural break on how households took on their financial obligations, such as rent, auto payments, mortgages. And in contrast to what we may have seen, perhaps beginning in the 1980s, despite lower interest rates over the period of 2009 to 2020, people are just being very cautious on the household sector in terms of looking at financial obligations relative to the disposable income. That tells me that, when Beth Ann talks about 1 or 2 rate hikes next year, I don't see it as a recession-driving factor. I know some in the media talk about that, but I just don't see it. I don't think 50 basis points is going to make that much difference when I look at the financial obligations ratio for many households. Next slide, please. In terms of the manufacturing firms, the net working capital, again, this is published by the federal government. Net working capital is pretty darn good. They get a lot of cash on hand relative to what their short-term liabilities are. That has really been an amazing break since 2019. Very, very positive. In a way, it may reflect caution so that when Beth Ann talks about non-residential construction being behind the pace of the economy, it may be that firms are holding cash, not willing to really engage in commercial real estate development, which is a long-term investment, until they have better visibility with respect to how they see the economy. So this is the yield curve in recessions. Again, it's pretty clear when that number gets pretty much at flat, a recession tends to show up sometime. Again, it's not perfectly predictable, but sometime after that inverted yield curve. We are not at an inverted yield curve right now. We still have, the 10-year, 2-year spread. And again, I would say if I were looking at this graph, I think that we just don't have the signal that we have a recession from the yield curve at all. Now, clearly, if we look at one or two rate hikes in 2022, and we don't know what the 10-year will do, but it will probably bring a flatter yield curve. It probably will not invert the yield curve. So again, it's sort of consistent with slower economic growth going forward. The corporate AA spread, as many of you know, corporate bond issuance has been incredibly strong. Corporations find that they can finance a lot of what they need to do, issuing bonds at relatively low interest rates and getting whatever they need to do get done, even if it's just paying off dividends and generating some business investment. I did think it was interesting, if you look carefully at one of Beth Ann's graphs, intellectual property, she didn't mention it, but intellectual property spending pretty darn strong when you look at business investment. So I think that was kind of intriguing, and that's consistent with a lot of the strength we've seen in the tech stocks. Here's the dollar-euro exchange rate. And, once again, it's just been an interesting path ever since 2009. Although, again, a lot of commentators don't focus on this. The dollar's actually strengthened relative to the euro for the past 10 to 12 years. It's rather fascinating. It's quite a change. When you look at the path of the dollar-euro, it's a long uptrend from 2001 to 2007 or 8, and then it's been a long downtrend since. So this is a series that has a long trend to it, both up and down, and it's rather fascinating. The dollar continues to be relatively strong compared to the euro, which makes our exports into Europe a little bit more difficult. But in terms of buying something from the euro community, it's a little bit cheaper over time. Next slide, please. And the dollar yuan, fascinating. I mean, you can see the very, very clear break in 2004, where the Chinese renminbi continued to depreciate up until 2013. Some appreciation since then, but again, the challenge being is that, what is this rate of exchange compared to what a free market rate would be over time? And that's an interesting concept to think about. But it does make a difference in terms of our imports from China being perhaps a little bit more expensive than they were in the near past. But again, it makes our exports a little bit cheaper when we compare with Chinese companies into third markets, such as most of Southeast Asia. Next slide, please. So here's China, a little bit on the global side. I think it's kind of interesting. I mean, there is a real question with respect to coal, COVID, and construction in China. Most of you are pretty familiar with Evergrande and some of the other major Chinese construction companies that are just having lots of problems. It is always true that any country faces slower economic growth as it pursues longer term reforms. It's always a difficult financial situation. And on the financial side, it's clear that, when you look at the high yield bond index for Asia and China, it really is taking a big hit. Property debt is really a concern. And it's always fascinating to think about China offering bonds in dollars and euro bonds, not issuing in their own currency. So next slide, please. Talk a little bit about the euro area. Two key questions, of course. To what extent that central bank activity is actually useful at this point in time. Inflation is traumatic for the Fed, but it's existential for the Eurozone. As many of you know, the old Bundesbank had a very, very tough stance on inflation. It'll be interesting to see to what extent the ECB wants to try to stay with that stance. Interesting challenge over time. The UK recovery is slowing. The pound sinks. So again, in the UK, you have a traditional problem. And then finally, many of you know my opinion. the Turkish lira is just a fine example for those of you that teach college, a fine example of why you need an independent central bank. Because the concept last week, there was an article talking about the Turkish central bank thinking of lowering interest rates while inflation is 20%. I don't know how that works. I mean, just to me, it doesn't make any sense at all. It wouldn't follow any textbook that I understand about macroeconomic policy, but it's a fascinating lesson for those of you that have a course in college you want to teach. Next slide, please. So here, Japan's economy a little bit stronger than many realize. I think it is true that many people are sort of thinking about Japan being sluggish all the time, but they've actually picked up their pace, which is pretty good, especially given their demographic challenge. The Bank of Korea are raising interest rates with an eye on inflation. I think that's always interesting to see these second-tier markets that have to react. And many of you are pretty familiar with if you are the major economy in the world, such as the US, we can change and impact the rest of the world. But when the rest of the world is looking at things like the Bank of Korea, they don't have that flexibility. And so they're raising rates to deal with their inflation story. Interesting story on Australia for those that are experts in monetary policy. Kind of intriguing. They sort of dropped their 3-year target. They're talking about monitoring it, but the exit was kind of disorderly, and the bond market sold off pretty significantly. Interesting perspective on Mexico, that Mexico could benefit from China's exclusion. And then, of course, as Beth Ann mentioned, the Bank of Japan has surprised investors by signaling an earlier move on interest rates. But as of this week, they maintain policy rate and forward guidance. So it's interesting, both the Bank of Canada and the Bank of England made public comments about policy that really shook the market. But then when the meeting came, they didn't do anything. So kind of an interesting challenge there. Next slide, please. So my 2 final points. One thing is to remember that a lot of market prices are in nominal units. So it's great to say the S&P has hit a new record or the NYSE has hit a new record. But when you look at an inflation adjustment, you might get a different view. The same thing for interest rates, profits, and especially exchange rates. Again, the federal government publishes the real exchange rate on a lot of items, but sometimes we just get caught up on these nominal units and thinking the S&P is an all-time high. Isn't everything wonderful? I think we need to be careful of the fact that these are nominal units. And finally, for bond investors, the markets can change very quickly. I love these headlines, high yield bond sales soar to a record November 26th. Commentary that low yields have left investors numb to risk. And then all of a sudden, December 1st, and if you look at the dates, it's less than a week later, US junk bonds hit by the sharpest sell-off in more than a year. So as investors, it's really important to understand that perceptions can change really pretty quickly. The Bank of Canada, the Bank of England, public statements, not following up on those statements, create a lot of volatility in the marketplace. That's it for me. Thank you for your attention.
All right. So I have an awful lot of questions. Thank you for sending them in. You can keep sending them in, although I have enough to keep us here until tomorrow. So we're going to do our best here. Let's get started. There were some questions with presentations, so let me go there first. There was a question that Beth Ann had posed about when will non-residential construction recover, and someone just threw a quick thought out there. Is that part of the market shifting towards online retail, or is that related to the recession? And is that part of your analysis?
Non-residential construction had always been challenged even before the pandemic recession. The pandemic recession hit it, full on. Why is because as this member had mentioned, the speed this, the speed from away from big box to online was already happening. It went on steroids during the pandemic. So that's one factor. Now, some businesses, some retailers, for example, who already had an online presence did well, or actually benefited from this. But that's one big factor that hits the retail, the non-residential area, and that will just continue. The other factor to take into place is that I mentioned that residential is doing incredibly well, doing it even more so because people bought their first home, second home, third, fourth. They moved out of big crowded cities. That also means that commercial real estate, meaning office space, is also challenged. I go to my office once a week. The need for that much floor space is not as necessary. That also means all the businesses that revolve around office space, all the restaurants and what have you, are also going to be challenged as well. Now, we're expecting to see, in our forecast, we do see non-residential construction to slowly climb higher in 2022. The question is how fast, and again, if it will happen at all. So I'll stop there.
And so if I follow what you're saying, before there's going to be new construction, there has to be people moving into the existing spaces.
Well, I would say one thing that, and maybe this member might even know a little bit more about this. Some people might do. Many people have moved out of city spaces. Some are coming back, but how many? But then the other thing is that because there's been a move out into the suburbs or to other areas, there is still some need for office space there. I just don't think it's going to be as big as what you would have gotten in the city world. I don't know, John, if you wanted to comment.
Perfect. Okay. Well, let's go back and let's hit something a little bit hard. And let me again say, the comments that come out of my mouth or any of our speakers' mouths are not necessarily those of the club. However, I have a few questions about the stimulus effect on labor markets, and was the amount of stimulus too much, not enough, or just right? And while we're answering that, let's separate. Are we talking about fiscal policy versus the Fed's response with monetary policy? And I'm going to let you both take a shot at this one.
Well, I'll be quick. On terms of the fiscal spending, we saw it as a bridge to the other side, particularly during 2020. We had an unemployment rate at almost 15%. We had 21 million, I think, unemployed at that point. So I saw it as a bridge to the other side. Whether the stimulus was needed in January, I was not necessarily as convinced. Some of it might have been, but I wasn't quite as convinced as that. I think that was his question or her question on the labor market, or is it on something else?
The stimulus effect on labor markets and participation rates, I think, is where they were going.
On the what we did find on the stimulus effect, there was a big question about, did this keep people on unemployment benefits longer? Did it convince people? Did it discourage people from entering the workforce and taking those jobs? Or I'm sorry, not entering, but staying unemployed and not taking those jobs. At the margin, there might have been a few, but we found that the real big story was labor exit. And keep in mind, labor exit, they don't get the unemployment benefits. Now, maybe the stimulus, those stimulus checks, for example, might have kept some people feeling a bit more cushion, not needing to go back to the workforce. But I think the real question was more fear than whether they could kind of ride it out. I don't know, John, if you want to comment.
Well, I will take on the monetary policy side, and I'm pretty sure Ken knows my opinion on this. I think there was just too much monetary policy stimulus. I think it really distorted the bond market and lowered yields below what the market would have dictated, because negative real interest rates don't make a lot of sense to me. So for me, I certainly agree. I think Beth Ann made a good point. The way I describe it to some of my friends is you had to have the initial stimulus to get out of the hole, but once you're out of the hole, what are you stimulating even more? And I think that what we saw by the middle of this year, 2021, is that you continue to have too much fiscal stimulus. I would oppose the latest projections in terms of fiscal stimulus. And, I think that, with respect to Beth Ann's point on tapering, I think it's important to understand that even though the Fed talks about tapering, it still is stimulus. So it's just less stimulus than what we had before. So for me, yeah, I would advocate that the Fed accelerate its tapering process, and I would oppose another spending program in terms of fiscal policy.
So right now, there are more job openings, according to the Job Opening Labor Turnover Survey, than there are unemployed persons in this country, depending on which measure of unemployment you want to use. How do we explain that?
That labor supply dropped. People left the workforce, and so that's one factor. And then, of course, you're looking at this hot economy, 37-year high in terms of growth. The demand is so extreme in a good way. I mean, it's wonderful to see something like this, but it's so hot, businesses just can't keep up. They're trying to get the workforce they need, but they can't. And it's not just the workforce; it's also the people who. It's also all the goods that they would need in terms of the inventories. Go to the supermarket or go to any market; basically, all the shelves are empty.
So, if I may again build upon the basics. With respect to Beth Ann's comments, when you talk about the openings, et cetera, I'm looking at this graph and it's telling me that aggregate demand exceeds aggregate supply at full employment. Why do you want another stimulus? Why do you keep on printing money and monetary policy? Why do you need another fiscal program? To me, I mean, you have to recognize that the labor force has changed. The participation rates have changed. People have exited the labor force. That unemployment rate, is down at 4.2% or so. That to me, yeah, you basically got full employment, except, and again, maybe Beth Ann has a point on this, look at less than high school. I mean, I think a lot of those folks are really structurally unemployed. The labor force participation rate for that group has declined pretty significantly. There were less employed in that group than they were before. I think, again, you have to do the long run education thing. You got to get people to change careers. You got to get these kids educated. You got to get them finishing high school because there isn't a future there given how high tech our society has become.
I would add to that, when you mentioned the unemployment rate at 4.2%, we were talking about the labor exit, why job openings are so high, but there's just not enough people to get those jobs. If you look at the unemployment rate adjusted for how many people who left the workforce, who basically dropped out of the workforce since the pandemic, that unemployment rate is 6.4%. Again, to explain the extreme distortions in the labor force, labor supply right now.
Okay, so then what do you guys think about the number of people that have dropped out of the economy to become crypto traders or day traders? And there's all these, this concept called the Great Resignation, where there's this movement across younger generation to disengage from the standard accepted economy and try to create their own versions of things that already exist, essentially. What effect is that having on labor force?
Do you want to go first? I always go first, so I was going to leave.
Yeah, well, I'll just give you my basic opinion. People make choices. If someone sees that their opportunities are greater being day trader, at least for the first 6 months to a year or so, I think that's fine. I have no problem with people trying to do that on their own, people going out and being consultants, quote, on their own. So to me, that's a short run adjustment. How successful some of those people will be, I don't know. But that is part and parcel of, free and open economy and letting people make choices.
On my end, so I kind of in line with what John's saying, but I would also note that when we talk about the self-employed, it's still small. I mean, we're not talking millions and millions. It's small, but it is rising. So that the jump is certainly something that people have caught people's eye. That's one thing. I'd also note that I think this is something that's watch what happens with the pandemic. Watch what happens with the vaccinations. Once we finally get to herd immunity, we might see some change. Right now, when we talk about that labor force participation rate, the largest drop of all the people who left the workforce of the labor force participation rate, 45% are people of prime age who just dropped out. Now, why is that? Again, I think it's tied to the pandemic. I think it will reverse itself at some point. So that's one thing that I would keep in mind, and I'll stop there.
Well, let's talk about COVID since we're here and the topic is so beautifully brought to us. Thank you for that. What are the assumptions that both of your economic predictions or your models have for COVID? What COVID assumptions are you making in your models? And while you're at it, there was a question: is the decrease in consumer confidence based on health-related reasons or for economic reasons?
So I'll jump in this one. And well, first on the consumer confidence, I think that it could be partly health related, but I think the big factor is actually John pointed it out. And I mentioned it briefly, but John covered it really nicely. It's like there's a good half of the population where wages are well into negative territory. That inflation hit on purchasing power is making people very unhappy. So I think that's one of the factors that's at play here. On COVID-19, the impact, again, it's we try and rely on our health specialists on this, not outside health specialists, because again, trying to predict this is a losing battle if you're an economist. But I suppose the big question is when we reach herd immunity, and that I think is still a challenge. I guess we're at 60-something% now in terms of, or 60+% in terms of vaccination rates. I would say we expect, I don't know I'll have to check on the outside reading in terms of when that will come. That's probably a 2022 story. But the point also is, to quote Fed Chair Powell, the US economy has learned to live with it. And that, I think, is something to keep in mind.
John, you had talked about real earnings rate being lower post-pandemic than it was before. Can you talk about household wealth pre and post-COVID recession?
Yeah, I'll be glad to, Ken. This is a topic that I've written about, people have talked about it, and I'm sure Beth Ann is very familiar with it. And I always start out with simply saying, you got to be in the market to make money. And the reality is that when you look at household wealth reaching all-time highs over the last few years, it is predominantly house prices going up and equity values going up. And if you're in those two markets, which someone like Ken and Beth Ann and I are, you win. And if you're not in those markets, you're not going to win. You're going to fall behind. So the problem, I think, for a lot of households is you've got to be putting money into the home. You got to be putting money into, quite frankly, the equity market. I'm not a financial advisor, but I can look at the numbers, and I can tell you that that is creating a lot of this, quote, wealth disparity that people complain about. You got to be in the market. It's like the old story when I was in Illinois, and they would say, if you want to win the Illinois lottery, you got to bet. Well, if you want to win the wealth lottery, you got to bet. You got to put money in the house, and you got to put money in the equity market, and you got to be a long run player. You can't be in it for 3 weeks and then take the money out because you have some emergency spending because you want to go to a game store and buy a game for $200. It doesn't work like that.
Okay, we're getting close to running out of time, so I'm going to focus on a few questions. The first one is regarding inflation. And as the trade bottlenecks are seeming like they're going to ease, what can we expect from a forward path of inflation? What is the path of normalization, or, over the next few years, what can we see?
You want to go first?
Yeah, sure. I mean, my position, I think, as Ken pretty well knows, my position is that inflation will moderate. It's probably worse right now, and probably for the first quarter of next year are the peak periods for inflation. It will moderate, but it is not transitory in the sense that you're going back to 2019, 2020. I just don't see it. I think you've got a lot more wage pressures in the marketplace that will keep inflation a little bit higher. You get a lot more uncertainty with respect to commodity prices, certainly energy prices. So I would say, yeah, okay, we've got 4% inflation in 2022 and maybe 3 to 4 in 2023, but not back to 2.
On my, so actually, Ken, I sent you our forecast report, and you can feel free to share that. But so in line with that, we've been saying that we don't see getting back. The supply constraints, we are starting to see some signs of easing, as I mentioned, but they're still well above 2019 levels. So that means it's still going to put pressure on prices. We don't see, keep in mind that we're going to probably start to see some capping of prices in 2022, partly because people are going to get tired of spending this much. So you could start to see once everybody finally gets to have a holiday season after almost 2 years of nothing, eventually that'll pass, and that forgiveness of these high retail prices will start to go away. Households will start to be a little bit more reluctant to spend at these high levels. Also, you have the Fed planning to raise rates into at least they're likely going to raise rates in 2022 and continues. That's also going to be downward pressure on growth and prices. But that said, we don't see, just my forecast is, I'm looking at it right now, we're not looking for it to get back to what would be pre-crisis level. Get back to what would be the Fed's target or average target of around 2%, not until 2023. Okay.
That's very good to know. And it actually is almost in line with what the Federal Reserve is saying, so that's nice to know. We're almost out of time, so I have 2 questions left for us. The first one is international. And there's a lot of things that we touched on. And John, you threw so much out in that one slide. But I have one question that encompasses almost all of it. Right now, China is the second largest economy on the planet. And as the world is recognizing China as somewhat of an antagonistic player on the global stage, and manufacturing does seem to be shifting away from China, which countries stand to benefit the most?
I think the countries that would benefit the most is first the U.S., second Mexico. I am frustrated by some of the latest news on Mexican politics. I just don't think Mexico has ever taken advantage of being a part of NAFTA. They had such an opportunity, and yet we still talk about Mexico as an emerging market economy, not a major industrialized economy. But I would say the U.S. would benefit first, and then Mexico second.
Beth Ann?
I would probably throw in some of the Asian countries like Vietnam, a couple of the other around, basically picking up where China left off. So, but again, you have, when we talk about the virus in the United States and other parts of the world, Asia is still struggling. So.
All right, and the last question brings together labor market. It brings together bottlenecks. There was a conversation, and I don't recall, I think it might have been John's slides about net working capital. And the question is that a response to a labor shortage? And is that maybe the corporate response? If we can't grow by hiring more people, we're going to reinvest in our company in some other way. Is there any truth to that concept?
I would say, Ken, there is a lot of truth in that concept. I don't think it takes you long to read either the Wall Street Journal or Financial Times to find articles about companies putting in business equipment that replaces workers or makes the whole production line a little bit smoother. So yeah, I think there's a lot of substitute of labor for capital for labor, given the cost of labor and the problem of finding the workers to do the job at the proper quality level.
Yeah, I would have to agree. I mean, we've written about I've written well before this. I've said that, everybody this is in 2016, we wrote about this. Everybody was blaming trade for the fact that workers weren't getting jobs. We said that it wasn't trade, it was automation, but automation got off scot-free. And now what we're looking at here, and it's understandably businesses are struggling to first stick with a hands-free transactions. That's one thing. And second, struggles to get workers. Well, maybe we're just going to speed up trying to figure out a way to have fewer workers. So I do think that is a factor that's going to play in, and it's just pure capitalism. It's at its best.
All right, I'm going to ask the last question. Give me a number. GDP growth rate for 2022.
I got 4.25%.
3.9, and I guess if it's higher than if we're doing the Price is Right. I got 3.9.
Well, fantastic. Guys, I want to thank you both. This has been enjoyable, engaging, and not a single person has actually dropped during the conversation. In fact, the number of participants has grown, so I appreciate that. For everyone else who's on here, we have events coming up, and if I look at the board, I see we have in February, we have Linda Huey, we have the Pew, we have all kinds of events coming up in the springtime. So we hope you pay attention. Go to the Economic Club website for upcoming events, econclublv.org. Also, please see our YouTube channel, Economic Club Las Vegas. And we'll have all of the replays for this event and slides, and anything you need will be available there. So thank you, everybody, and have a great day.
Thank you.
Thanks. Happy holidays too.
You too.